Practice makes perfect. Let's take a look at a case study to see how we can bring all of these techniques together. We're going to keep building on this in the next section where we get into position sizing and portfolio management, and eventually we're going to get to market analysis. But let's take a look at how all of our buy and sell techniques can really come together to get us into a stock at the right time with low risk, how to add to that stock, when we hold, and when we have to sell. Really, again, you can adjust your style with all the different tactical patterns that we have. If you don't like buying breakouts, use pullback buys or expectation breakers. Just you have to understand the implications. If you're not using breakouts, you may just miss out on some stocks that break out and take off. So I really like to use a mix of all of these, but you can go back and study charts. I think this is a great example of how you can go back and study other great winners of the past, print out your weekly, your daily charts, and really annotate where you would have bought, what percentage of a position, where you would have sold, and really go through the whole process. So the stock we're going to look at here is Roku as a perfect example of the ideal buying, holding, and selling of the stock. And later on, we're going to look at multiple examples of how to bring all of the sections together. So let's take a look. Here is a Roku weekly chart with the relevant fundamental metrics. You can see this is the cup base that we're going to be analyzing later. But at that point in time, this is the fundamentals that were known. Eventually, the stock had its major advance. And again, big investors knew that these huge earnings were coming. But you could see when the earnings weren't present, like I discussed before, big sales growth, consistent sales growth is something I'll use as enough of an indication of a potential major winner, because the stock is proving that it's really rapidly increasing its customer base. It's really important that you also understood the story behind Roku and what they were trying to capture. They're really trying to become the ecosystem for streaming TV, and they'll be grabbing a lot of the advertising dollars in the process. And with the COVID-19 pandemic that developed, a lot of people were going to be spending a lot more time at home watching a lot more TV. So whatever business they had, it was only going to accelerate under those conditions. And that's really what led to this fantastic stock advance from about $140 a share to almost $500 a share in a relatively quick period of time. So once you had that fundamental basis to your analysis, you understood the story, you saw the strong sales growth, you could see how that could even be accelerating given a new dynamic in the marketplace. Let's dive in and see how we could have actually timed our entry points. This is that same weekly chart we've looked at before, so we know we had all of those elements that were present at the time. We had that great cup with handle. You saw all of these tight closes, essentially closing weekly prices within a 1.5% range, showing that institutions were really accumulating in an area. And you had that great breakout above that handle right here on the right side. You had all of the volume spikes within that base, showing you that there was significant buying coming in on all the up weeks. You had a prior uptrend off of the low, so you didn't have to be diving into the stock as your risk was huge, as the pandemic was happening, and really not knowing what kind of risk you had. You could have waited for that first initial prior uptrend, that first base to form before you began becoming very aggressive in the stock. So once we had that initial uptrend off the low, and we saw all of this tightness happening on the right side, let's take a quick look and see how we could have timed that further with our tactical patterns. Going back to our dollar stop analysis from earlier, I want to bring out some key information again, because again, we're going to be position building here, and it's important that you understand how all this works together. So I'm assuming 25% of your account equity will be a full position for this stock. Each buy is going to be a third of that full position, or 8% of your account equity. And your max stop is a fixed percentage of the AUM, regardless of that position size. So you can review that section if you're not sure. So essentially, we have this great cup with handle forming here. And we have this bad break failure of the 50-day. We have this break here below that 50-day moving average with volume a little bit above average. And 2 days later, we get back above. The reason I begin the buying here is that this is really the first buys that show up above that 200-day moving average. That's one of those principles I use, and that's why I was ignoring prior buy points in this example. This down here, this bottom indicator, we'll cover later in the market section, but I included that when you eventually review this course a second time. You'll probably want to have that information down there to understand the market dynamics. So if we continue with this example here, we would have bought that initial 1/3 of a position on this green candle due to this bad break failure. Your initial stop would have been $116.25 per share, 5.6%, which is the low of that bar. And if you use the dollar stop, your low would be 6%, or $115.80 a share. So there's a case where the dollar stop would have been greater than where your actual stop would have been anyway. So you could have just used the low of that bar. We advanced here and we break out of this cup with handle buy point. So that's your second buy point that comes up relatively quickly. So you buy another 8% of your account equity, so another 1/3 of your full position on the cup with handle buy at 134.90. That's really, it looks relatively close, but given the volatility of the stock, that's actually 9.5% higher than the original buy point that we bought above this red candle. So the new cost here at this point is $129.05. You have a 4% maximum stop with a stop at $123.90. You can see that stop has moved up here with the red line. And we did pull back a little bit the day after that breakout. If you were buying solely on this initial buy above the handle area and didn't have a lower cost basis thanks to an earlier buy, it would have been a little more difficult to sit through this because these bars look small, but on a percentage basis, they can be rather large. But thankfully, our new stop was not hit. Our dollar stop methodology was able to keep us in the stock. We advanced higher. On this breakout, we advanced 20% in only 3 weeks. So we need to hold this for a minimum of 8 weeks. So this is where we triggered our hold rule. Now we have to stay in and we want to shift our attention to selling only if a shaper pattern shows up. So we pull back here and we form a 3-touch trend line. And so also we have a mini coil here that develops. But we want to buy on that 3-touch trend line for our third purchase to make it a full position. It's now 24% of our account equity with an average cost of $138 a share. With a max stop of only 2%, our dollar stops, that would be $135.25, which you can see with this red line. This is your new line in the sand that you want to pay attention to. And it's really important that you have this lower cost basis. Again, if you would have bought solely on this purchase here, you would have been stopped out when this rolled over. But because you had a lower cost basis and you knew you had this great shaper pattern, you have this hold rule that's in effect, you were going to buy this stock on this third purchase, and now your stop allows you to stay in, and you never have a greater risk than you did when you first bought the stock. Because our stop naturally tightens and keeps a consistent dollar amount, you have a relatively tight percentage loss, which is the same dollar amount as you did at the beginning, and you're never stopped out of the stock. Here we have our first touch of the 10-week moving average, but we do not buy because it's actually lower than our prior purchase. So you never want to be adding to a stock lower than where you bought it before. That's only going to raise your stop point even closer to your exit. So you really want to be adding on to strength so your cushion builds with time and you always have an adequate distance to your stop. We advance here again after the 8 weeks hold rule is up. You can tell this is really potentially a super winner here. So we're even higher at the end of the 8 weeks. And so we're only going to use these shaper cells. After this advance, we pull back one more time and we find some support along the 10-week moving average in the 50-day. And at this point here, we have a nice kicker after a significant amount of time that's been forming. So you could have added on this kicker pattern and another 1/3. Now you're starting to get into an oversized position, but it's proving to be a major winner and it's holding its averages. You have your cushion has been building. So you could have purchased this at $166.10. Your average cost would become $145. But because you're already up substantially on the position, this is a break-even stop here. You say, I'm not going to lose any more money on this. So it does tighten your stop somewhat, but it's no longer a stock that you'll lose money on. So you have basically 1/3 of your account in one stock with incredible potential, showing great volume and price characteristics, with no downside risk and a significant amount of upside potential. So we're going to flip back to the weekly chart to see how this would have unfolded and to see what kind of profit we could have made. So eventually this kept advancing for a significant amount of time, and we eventually got above an upper channel line at $425 where you would have sold. It was 6 months since that initial base breakout, so it was you were allowed to sell it to an upper channel line. Again, you want to wait at least 4 months out of a stage 1 or stage 2 base before you can sell into an upper channel line break. And that's the first shaper sell that does occur. Eventually you had some breaks on the 10-week moving average, but you really want to sell into strength here after such a long time of advance from that first base breakout. And so our average cost again was $145. It was a 32% of your account exposure. Selling at $425 was 193% profit in a rather short period of time, 6 months. And that would have had an impact on your account of 61.75%. Now think about it, that one position advanced your entire account by almost 2/3, and you accomplished that with risk that was a fraction of a percent. So that's over 60 times your risk. You don't need many of those trades in a year or every couple of years to substantially improve the returns that you're achieving in the marketplace. So there's a great way, a great study. I really recommend that you do this with other stocks. Again, we're going to have additional deep dives later on in the course once we cover position sizing as well as market conditions. But there's a great way you can do a case study for yourself, and I really recommend that you work on the position sizing, your dollar stop, how it advances over time, and your eventual sell technique, and really bring all the concepts together, and it becomes very, very powerful.